Good afternoon, everyone. We are here to basically have a conversation on what are the emerging trends in private equity. And we have two esteemed guests with us today. We have Tarun Khanna, partner, CX partners. Tarun has made significant contributions to the investment landscape, particularly in consumer products and service sector. We also have Mahesh Parasuraman, who is a co-founder of Amicus Capital. Mahesh, of course, brings a wealth of experience. The Amicus is focused on investment in technology, financial services, consumer sectors, amongst other things. Thank you, gentlemen, to agree to come over this discussion. Appreciate. We were talking about the emerging trends in private equity, and obviously, we have two most prominent private equity players and two most prominent individuals who will share our experience. And the idea is to make sure that we make this discussion very informative for our viewers. And with that, I think I will broadly, attempt to cover what are the emerging trends in the private equity. And why don't I start with one of the things that we have been seeing a significant shift by private equity is towards the control deals in recent past, which is perhaps in some sense a reflection of what the Western market has been doing for quite some time. So, keeping that as a base, just wanted to understand, Tarun, maybe we have seen CX doing a couple of, several control deals, whether it is Talakapatti, that is Minax, where you guys have taken a controlling stake. So, what do you believe? What is why are private equity increasingly shifting towards doing a control deal versus minority investment? Would love to hear your thoughts.
Sure. Thank you. Thank you, Siddharth, for having me over. So the question on control is a very fundamental one. So if you look at the Indian private equity market landscape, it's at best maybe 30 years old, right? Started somewhere in the mid 90s, went through the dot-com phase, and then started consolidating in the first, between 2000 and 2010. At that time, it was largely minority driven. Even we used to do a minority. There were some buyout funds at that time, largely the global funds that were looking at a few majority transactions. The lack of, there was really a lack of high quality deals, high quality businesses where promoters were shy of selling. So the traditional businesses, the family owned businesses, people were not selling. And the high quality businesses, which were more entrepreneurial driven, after 1991, people got together. So whether it was in tech services or financial services or healthcare, those businesses had achieved a certain amount of size and scale where the second generation maybe wasn't interested in coming, and they were not able to grow beyond a certain glass ceiling, etc. We as minority, we were always growth minority investors. We lacked the ability to basically hire high quality management talent at that point in time. This is 15 years ago when we started, right? CX in 2008. And we were very comfortable doing minority deals where we were backing the promoter to grow the business. Halfway through, maybe 10, 12 years ago, we realized that there was talent available at that level, at the senior management or at the board management level, where we could hire people, especially in healthcare or IT services, even in financial services. And that's why the first buyout deal we did was in Minax, where we bought out Aditya Birla's BPO business. That was a 100% buyout deal, where we could find high quality management talent to run the business. Now, on the face of it, if you compare a minority versus a majority deal, it always makes sense to do a control deal because you can drive strategy, you can drive the board, you can get best governance standards in place, you can hire high quality management, and more importantly, you can drive the exit. With a promoter run business, it's not always that you can drive the exit, and you typically you have a suboptimal exit. So you have to do some upside sharing, etc., with the promoter. I think one of the things that was lacking in Indian private equity because of the level of maturity we were at was the conviction that we have high quality management available to run the business. Of course, private equity was in control, so you'll have board control and you'll have to kind of drive strategy yourself and drive governance. But the most important thing was that we were not operating partners. We would hire the management and run the business. So that level of confidence and conviction, I think, we've kind of developed over the last 10, 12 years. So we in fund one, we did 2 buyout deals and we did 2 co-control deals. So Sutures was a co-control deal along with TPG, where we came in at minority and then TPG came in, and between us we had control. And then we hired 3 CEOs there. The first one didn't work. The second one was average, and finally the third one was a rock star, right? So we went through our sinusoidal curve of understanding how actually a buyout control deal works, and the ability to hire, fire, etc. And now in fund 2, we have 4 control transactions in healthcare, in consumer, 2 in healthcare actually, and we are doing another one. So the third one in healthcare. So we feel more and more confident, and we've kind of got a playbook ready as to what do we need to do. So I think that confidence level is really coming, and that's why we're seeing more control.
Got it. So, Tarun, just taking it forward, control deals, of course, has its own benefit, like you mentioned. But in your experience, how do you handle, the resistance from the existing management group? Do you try and bring in new players? You mentioned about certain hiring at the key level that you make, and how do you balance the interplay? Is there anything in particular that you would like to kind of share with us?
That's a fantastic question. Actually, what has worked best for us is not 100% buyout. What works, and we have a LP, an anchor LP, CDC, which is now BII, and Mahesh also has the same LP in Amicus. So they did some research for all their GPs. The best returns that CDC has gotten out of its GP portfolio is that segment where they have done buyouts, but they have retained the original promoter with at least a 25% stake. So what happens is, when you buy a business, you can drive strategy, you can drive all of that stuff, new markets, business growth, BD, NPD, you can do all of that stuff. But the basic concept of running a business and controlling cost is something that the entrepreneur is very, very good at. He's done it for all his life. You can't replicate something in 6 months. So you have to give credit to the entrepreneur. Now you can say, boss, I'm buying this business at $100 million. It took you 10 years or 20 years to get to 100. I'm going to take it from 100 to 305 years, right? So my IRR, my growth curve is fantastic. Fact of the matter is, the guy built $100 million business. He's not a dumb guy. He's a very smart guy. Okay, right. He knows how to control costs. So I'll give you a real life example. Sapphire is owned 100% between CX, or it was, we sold our position, CX, Goldman, and Samana. And Devyani Foods was the Ravi Jaipuria business, which also had private equity. Both of them are now listed. If you look at the way Devyani is run versus Sapphire is run, like to like comparison for Pizza Hut or KFC, their food cost, their operating cost is lower than ours. It's a promoter driven business. They will be able to manage costs. I'm not saying they're cutting corners. They just manage costs much better than a professionally run business. So there are some inherent advantages there. So in all our buyouts now, whether it is Vida or Talpakatti or Sekhmet or the other one that we are doing in healthcare now, we are retaining the promoter with at least a 25, 30, even 45% position. And the promoter has an executive role. The promoter sits on the board. He has an executive role. He has a job description, and he will participate in monthly reviews and quarterly reviews. And so it's critical that we keep the promoter.
Understood. So Mahesh, let me come to you. Again, just taking it forward in the control context. Do you believe, in your experience, does it influence a minority versus control? Does it have any influence impact on your exit strategy? Do you think that exit becomes slightly easier because you are at the controlling seat? You are whether it is in context of exit vis-a-vis IPO or any other exit outcome, because you are pretty much at control. You want to make sure that the management is to your likes, and you can do the tweakings because you are at the driving seat. Any thoughts, any experience that you would like to share on that?
It does have an impact, in my view, on whether you have minority versus control. I think when you are in a control position, clearly, and when the investor has control, I think the decision to exit is a very logical and unemotional decision based on timing, returns, future value, and growth in the business. Whereas when you are in a minority situation where the founder is running the business, I don't think they have a clear timeline because they're building the business for eternity in many ways, or at least till the time they want, and they always believe that the end goal is really some IPO of some kind. Um, right. Whereas an investor on the other side who's owning a business, I think will do what is best for the business at that point in time that will maximize value. So I think those are definitely considerations that come into play, and private P run own business exit is, I'd say, relatively easier because it's set up in such a fashion that the ownership passes from one investor to the other potentially. It doesn't have to be always selling on an IPO, or it could be to a strategic, but at least set up from a governance point of view. Um, the distinction between ownership and management is well defined. So I think all those are clear indicators for you to actually do a transaction, and you can crunch the timeline for an exit as well. So I think those are definitely points that point towards a favorable exit outcome in a control situation.
Understood. No, I think it makes sense. Also, let's also talk about, in the recent years, we have seen a substantial shift in the investment world with the ESG factors, right, becoming increasingly important and visible in the decision-making process for the private equities. So, well, it does not just help in mitigating the risk, but also is, identifying the opportunities, enhancing the value of the investment, recognizing the importance of sustainability, ethical practices. So, keeping the ESG factors, which is very, very prominent these days in a private equity or even venture capital context. What are the steps, Mahesh, that, Amicus that you as a private equity fund take to kind of, integrate with the ESG factors? Anything in particular that you would like to share with us?
I'll maybe step back and give you a slightly longish answer. When we set up the fund way back in 16, we decided that we will have a very sharp focus on this, on ESG. I think this was driven by obviously a multitude of factors. One was, I think the world itself was moving towards ESG. It was not just institutional investors, but also on the fundraise trail, we realized that a lot of family offices now are the second generations that are coming in, or the third generations, were now a lot more aware and wanted to imbibe ESG as a philosophy. So we went back and said the best way for us to do it is to really integrate this into the entire investing life cycle. And so we sort of started this from day one, did a ESG diligence on all our companies, and then very early on we brought on board a very experienced ESG professional who drives ESG at the firm. Now, ESG can be defined in many ways, but we see this more as a risk mitigation measure, because I think in India, to be able to go and tell a founder, especially when you're doing minority investing, that you need to do a bunch of things, I think it was not easy. But what we saw that as more of a risk mitigation measure, how as a governance practice, so that when you exit, hopefully it's easier. People see this as a well-run company, and I think that's really how we went about it. We spent a lot of time trying to train our teams, and for that, it was important that we actually got a dedicated person. So, in most companies that we go in, we do a bunch of things. After we do a diligence, there's an ESG action plan, but we go beyond that. We do a number of trainings, handhold them, and do a periodic check-in on a quarterly basis to make sure that our company actually imbibes this as a culture of risk rather than to say that, look, there is an investor requirement that comes in.
Understood.
We then went one step beyond and we said that, look, our data collection and dissemination exercise was too sporadic on an annual basis. So we need to make this a little more periodic, and started collecting all of this data on a quarterly basis. In fact, now we are moving towards actually building some kind of a microsite where we can report to investors on a quarterly basis on what our companies are doing, what activities. So I think we have gone beyond what investors require on one side, but have viewed this as essential to the one is to governance practices, to improve, strengthen governance practices that will help us hopefully at the time of exit. B is also to demonstrate the kind of impact that our capital can actually make, the catalytic impact that our capital can do going into companies, and showcase that. We believe that we want to do it for both reasons. So,
understood. So, Tarun, do you again taking the ESG discussion forward? Do you, in your experience, see apart from having ethical practices, improving governance, mitigating the risk like Mahesh mentioned, do you see other commercial benefits, for your portfolio? Do you see impacting the valuation? Would love to hear your thoughts on that, Tarun.
Yeah. So, so both Amicus and CX, if you see, we are, effectively at the lower end of the mid market, right? I mean, we don't do these multi-billion-dollar kind of deals, $100, $200 million. Sorry, I mean, Mahesh, I'm speaking for you, but broadly, we are in that same range, right? 100, 150, max $200 million. Businesses in this segment have good business models, entrepreneurial driven, and he's got his 2-3, inner coterie of 2-3 people, but he's largely driving it through SOPs, right? The governance and ESG aspect of those businesses are purely lacking. It's not that he's doing it on purpose, he just doesn't understand it, right? And initially, so both for BII as well as GIC, so because GIC also has an LP. ESG started off with sustainability and environment, and today it's kind of evolved into impact on women and impact on employment, right? But if you look at environment, sustainability, I mean, you can call it ESG, but if you are going to be in a business segment which has to grow sustainably at 25% CAGR for the next 5-10 years, it has to be inclusive growth, especially if you're at the at the lower end of the market, right? So we were doing a lot of these things, but we were not documenting it the way it should have been documented. So a lot of documentation, procedural matters is something that we kind of understood a lot better, especially when BII came on board, right? Going forward, a lot of these, so there is, of course, resistance in minority deals because this is expensive. It's not a cheap exercise. It costs anywhere between $50,000 to $75,000 initially. And because there are lots of gaps, right? So you got to identify each gap, and then you got to put together a plan for the next, let's say, 2 to 3 years. How are you going to take it from, X to Y, right? And all the LPs know that in the mid market there will be gaps, but please put together a plan of how you're going to get there, right? And then annual monitoring and things like that, and you have to have a compliance and ESG officer. So all that costs money. So in a minority deal, there is resistance. So sometimes we share costs and things like that. But in a control deal, of course, I mean, you control the business, so it's a lot more easier. But I think the perspective is very clear that when you buy into a business, ESG compliance across segments, whether it's there or not, you need to document it where the business stands. If you're a first-time investor, I can guarantee you maximum 50% compliance over, and you should not be surprised if it's not even 50%. But during the period of your investment, let's say you hold it for 3 years and then you go sell it, if the compliance level is similar or hasn't moved up much, then it's really a red flag on your ability to manage that. Because you are the first time investor, you should have done those things. So that's when your LPs come back and say, and also it also has an effect on valuation. So let's say I buy $100 million business and 3, 4, 5 years later, I try to sell it for 250, $300 million to either a global fund or a large Indian domestic. They'll say, boss, okay, fine. When you bought it, it has these issues. Today, it has the same issues. You haven't fixed it.
Right.
So I can understand when you bought it, it had those issues. So you paid single-digit multiple. You expected to pay,
Right.
high double digit or whatever, low high teens. So the quality of the business should go up. Business is improved. ESG should also go up, right? So I think it's a part of the investment process now. So when we do our quarterly reviews, we have a separate discussion on ESG, just like we have on business plan. This was the operating plan. Where do you stand on it? Similarly, this was the ESG operating plan. Where do you stand? And and we've gone through a few exit scenarios over the last 2 years, where the incoming fund has specifically asked for because these are large funds, right? Global funds. They all have ESG compliance issues. So they've asked for ESG reports, and they're actually quite happy when they see that.
Right. Yeah. Well, no, that's very helpful. So that brings me to the last segment of this discussion. So, well, we have, we all are aware of the advent of artificial intelligence. It's kind of and the comfort that it can give to a private equity investor to kind of invest in that portfolio, keeping how the promoter is. I guess, technology has its own limitations, but in terms of portfolio companies, a company using a potential portfolio company using AI tool versus not using an AI tool, does that have any impact in your decision making?
But coming back to your to your original point. So a lot of our portfolio companies, so IndieFi, run by Alok Mittal, based out of Delhi, which is really a SME lending platform. I mean, that thing he predicts his delinquencies based on his algorithm, which is an AI-based algorithm, right? So he keeps updating it and things like that. All NBFCs, all retail lending, BNPL lending. I think financial services at the retail level has either moved to some kind of machine learning or will move to some kind of data analytics or AI supportive analytics in the next 12 to 24 months, because that makes total sense. At the corporate level, it's going to take time.
Right. But also, just one more thing, in connection with this AI, because it is such an evolving sector, and today we have a particular version, and 6 months down we have a new version. So how does, as a private equity investor, if you bet on something and 6 months, 7 months down the line, there is an evolution of technology and something, and it kind of completely makes that business unprofitable, if not, so how do you kind of benchmark
Fantastic.
that? How do you?
Very good thing you raised. That is where it comes to what Mahesh said, founder selection. So you back the right guy. See, when it comes to AI or any SaaS business or any data analytics business, and Mahesh knows this better than me, but the business model evolves. The business model has to change every 6 months because technology is changing so quickly. The business model has to change every 6 months. So the founder that you back has to understand that, and he's the one who's going to drive that change. Even if it's not changing, he's the one who's to drive it. So these are all, there has to be somebody sitting at the top, a founder, a human sitting at the top, driving all of this. So we are still not comfortable, or at least I'm not. We are still not comfortable that it's that analytics has reached a level where whatever data it churns out, whatever results it churns out, is accepted the way it is without any human intervention. I think that is going to take some time.
Understood.
And why don't you give your views also on this? Yeah, this is a critical point.
Look, I think that many of our businesses, at least the stage at which we underwrite our businesses, I don't think have what I call a 0-1 risks. What I mean by that is that most of our companies, hopefully, Yeah, we all go in with the thesis that will return at least capital. We don't lose capital in our businesses, right? Which is what private equity is all about, as against a venture business that is taking the 0-1 risk. So while there's a lot happening in the AI space, I think we as investors or at least funds, I don't think are at that cutting edge underwriting at this point in time where we can go in and back that, because that requires a very different portfolio construct in itself. You can't selectively go in and pick one company expecting that you'll hit the ball out of the park. You can't do that. I think you'll need, and it all boils down to how you construct the portfolio in many ways. What is the risk that you underwrite, right? You can do it if maybe somewhere mid-stage where all your existing initial deals that you underwrote are all rock stars and you want to take an outlier bet. Maybe it works out, but that's not how at least we think about portfolio construction. So I think for us as a fund, I think there's not enough scale. The revenue models are not proven, so it really doesn't fit in with the thesis. But what we are definitely are paranoid about is how this affects our portfolio companies, in terms of their business models. How do you future proof those? What kind of investments you are making in technology? When we started out with Fund 1, we started with saying tech is a good to have, but very quickly realized that it is one pillar of how our investment theme of how we think about it, which is really digital transformation or digital in itself. And I think that has become core to how we evaluate one part of our evaluation criteria, simply because of how technology is starting to play a more and more important role in many of our companies, whether it is in analyzing, whether it is in underwriting, whether it is in providing information, bringing operating leverage. You'd think that in a company like Amicus that manufactures aerospace parts, there'll not be enough tech and digital. You'd be surprised, right? I think we're spending enormous amounts of money on the shop floor to digitize what you're seeing, and people will be really surprised that companies manufacturing aerospace parts are spending so much in the shop floor on technology to help make decisions. So I think that this is now all pervasive. So it's going to be an important evaluation criteria for us in our portfolio companies, and also how we support them in making sure that they think ahead of the curve, be ahead of the curve. But I don't think it's a segment that, at least from our side, we will actively choose to make investments in, simply because of the underlying risk that it really provides or brings along with it in the portfolio construction. And I'm sure that's not very different for Tarun, given how they think about investing, at least for now. As the cycle matures and business models evolve, I think that I'm sure we will also look at it. Maybe when you're looking at the next analytics deal, it's quite likely that a large part of that will be driven by AI and will automatically come into play, into the transaction analysis and whatnot.